In this segment, we're going to start looking at the economics of business firms. And so for the next few class sessions and in the next several chapters in the text, we'll be talking about how business firms operate. And in other words, what is their major objective? And so the question is that we should ask ourselves and really have fixed in our minds the idea of what is the primary objective of business firms. And I think sometimes we don't always approach this with the total clarity that we need, particularly some in management who believe it's one of these things that maybe is not the correct answer at the end of the day. For instance, is our goal to minimize total costs? And the answer is no, not really. It may involve that at some point, but that's not the primary objective. Is to minimize the cost per unit, what we call average total cost. If total cost is the total cost of production, and I'll be elaborating more on what that's all about, then the average total cost is the unit cost. What does it cost us per unit? Total costs divided by the number of units produced. And the answer is no, that's not the objective. Is it, as some people feel, to maximize total sales revenue, what we call TR or total revenue? That is the maximum amount of sales. And the answer is no. Instead, the objective is to maximize profit, which we simply designate as the pi symbol. And so this is the objective, to maximize profit. And if you take a finance course in the business school, you might also, in addition to hearing maximize profit, maximize the value of the firm. That's more of a financial objective that we're not as concerned about in economics. Instead, profit though we are. Well, when it comes to profit, what is profit and what is the formula that we should be looking at for profit? And it's a very simple formula that in general is very logical, easy to understand, and it's simply revenues minus costs equals profit. In other words, profit, the pi symbol, is equal to revenues, total revenues, minus total costs, TC. And when we think about revenues, the definition that we ought to provide for that is this. We're simply talking about inflows to the firm. Inflows to the firm in the form of money, in the form of promises to pay, whatever. If it's an inflow to the firm, and we should probably clarify, in the normal course of doing business. A company winning a lawsuit would not be a revenue because that's not the ordinary course of doing business. So revenues are inflows. We sell a good and we receive an inflow. That's pretty straightforward. Whereas total costs are outflows. Outflows of money or promises to pay. Nonetheless, it's the idea that costs are outflows. So profit, at the end of the day, is the residual between revenues and costs, or inflows and outflows. And this is a pretty straightforward thing to understand. The thing, though, that we should sort of elaborate on is what kind of costs are we talking about? And in the next few videos, we'll be talking a lot about the issue of cost. It comes up again and again, particularly in the economics of business firms. As you can well imagine, cost is an important issue. And even though minimizing cost is not the primary objective, it may be one of the strategies to achieve the primary objective, that is to control costs. So if we go back to this original formula here, we should talk about the fact that profit equals total revenue minus total costs. But there are different kinds of profit that we should know about. The first kind of profit is something simply known as accounting profit. Accounting profit, which equals total revenue minus total cost. And the total costs in this case are simply only include those costs which we call explicit costs. Those costs which we call explicit costs. And what they simply are costs that are easily recognizable and sort of fit the accounting definition of what a cost should be. Measurable, verifiable, reliable, people should be able to rationally agree. These are costs like payroll expenses, things like lease and rental expense, inventory costs, things of that nature. So accounting profit is the profit that you might see on a business financial statement. In economics, however, we're much more interested in something called economic profit, which starts with the same basic formula, total revenue minus total costs. It's just that here we have another layer of cost, and that is we have an additional layer, in addition to the explicit costs, we have another layer of costs that we call implicit costs. And implicit costs represent costs that are not directly attributable to the operation of the business necessarily. There's probably no check being written for these. They would include compensation for the owner's time. If you start a new business and you left another occupation, then the salary or income you gave up in that old occupation is an implicit cost. Many other kinds of things that would be included in this, like what other alternative uses for the assets under management could be had. And so as a result, what you're going to end up with is another layer of cost. And so at the end of the day, what we end up with was economic profit includes these opportunity costs, the value of foregone alternatives. And while there are opportunity costs involved in explicit costs, it's the implicit costs that are not quite so obvious. And this is one reason why the accounting world tends to shy away from including very much discussion of implicit costs. So at the end of the day, what we should say is that economic profit should be less than accounting profit. And the reason is very simple, because there's another layer of cost that is involved here. But the thing to know about economic profit is this, as opposed to accounting profit. Accounting profit could be positive, negative, it could be zero, but you could have positive accounting profit and zero economic profit depending upon the amount of the implicit costs. Or you could have a positive accounting profit and a negative economic profit. So the thing to know is that we're very much interested in this course in economic profit. And so going forward, whenever we illustrate the pi symbol, what we're talking about is the fact of economic profit, and that's what we're going to be looking at, is economic profit. So I hope this is helpful at helping you to understand the differences between accounting and economic profit. And as always, feel free to contact me individually with additional questions.